Hello everyone, and welcome. I'm excited to kick off today's presentation with a focus on how to leverage high risk-to-reward ratios for significant profit potential on every trade. We'll be exploring the high R model, where adopting sophisticated entry strategies used by smart money institutions can make a real difference. We'll also look at how to execute trades with surgical precision, minimizing risk while maximizing potential. And of course, I'll introduce you to sniper entries using the smart money concept, especially on lower timeframes. So, let's dive in and discover how to take our trading to the next level. Let's talk about the importance of sniper entries. These entries are all about reducing risk while maximizing reward, ensuring you place your trades at the most optimal moments. When you get this right, it really helps in managing your trades more effectively. Using smaller timeframes is a game changer here. They allow us to set tighter stop losses, which is crucial for preserving capital, because the less risk we have on each trade, the better our overall risk management. Aligning your execution with these precise strategies is what smart money players do. They know exactly when to step in, and that's why tight stop losses are so vital. They keep the trade under control. Lower timeframes also give us the ability to pinpoint the exact moment to enter. This helps refine our timing, making sure we engage when the probability is highest. On the other hand, higher timeframes are essential for understanding the bigger picture. They give us the overall market bias and the directional conviction we need to stay aligned with the bigger trend. So, in essence, the lower timeframes help us with precision execution, finding those perfect entry points, while the higher timeframes guide us on the overall direction we should be trading in. The purpose of lower timeframe entries is to fine-tune our timing and execution, ensuring we get in when the odds are in our favor, all while keeping risk in check. It's about combining both perspectives to make smarter, more disciplined trades. All right, let's talk about why no confirmation means no trade. Discipline is absolutely key when it comes to executing with precision. You want to wait for those strong signals that confirm your setup is valid before jumping in. Look for a strong rejection or an engulfing candle formation. These are powerful indicators that the market is turning or rejecting a certain level. When you see this, it signals a potential shift in market sentiment. Speaking of shifts, a market structure shift, or MSS, is crucial because it indicates a clear change in the market's direction. It's like the market telling you, hey, I'm about to move differently now. You also want to observe a sweep of liquidity on the lower timeframe. This means the market takes out stops or liquidity pools, which often precedes a strong move. Spotting this liquidity sweep can give you an edge. And don't forget, it's important that price interacts with a significant higher timeframe point of interest, or POI. This shows that the bigger picture is aligned and adds strength to your setup. Finally, you should only enter trades when all these conditions, like the MSS, liquidity sweep, and interaction with the HTF POI, are met on the lower timeframe. These core rules help keep your trading disciplined and precise, making sure you're only taking high-probability setups. When it comes to trading, I always emphasize precision over frequency. That means focusing on high-quality setups rather than trying to take every possible trade. It's about patience and selecting the right moments. A crucial part of this is setting a tight stop loss just beyond the confirming market structure. This helps limit risk and protects your capital if the trade doesn't go your way. Think of it as placing a safety net just beyond the point where the market confirms your idea. Next, I look to enter the trade at a refined order block or a fair value gap. These are areas where price shows a clear imbalance, giving me a better chance of a successful move. Entering on a refined level increases the probability of the trade working in my favor. Before executing, I want to see a confirmed market structure shift in my intended direction. This confirmation signals that the market is ready to move in my favor, aligning with my overall bias. I also keep an eye out for liquidity grabs or stop hunts on lower timeframes. These are often the moments when the market is flushing out stops, creating a quick move that can be exploited. Identifying these on lower timeframes like the M5 or M1 can give me an edge. Speaking of lower timeframes, I then switch to a smaller chart, such as the 5-minute or 1-minute, to refine my entry. This allows me to be more precise and wait for the price to reach my identified point of interest, which could be a higher timeframe level or a strong support or resistance zone. Throughout this process, I establish my higher timeframe directional bias. Knowing the overall trend helps me stay aligned with the market and increases my chances of a successful trade. Finally, I follow a clear step-by-step execution model to ensure consistency. By combining all these elements, precision, structure, liquidity awareness, and timeframe analysis, I can trade with confidence and discipline, always aiming for quality setups over quantity. Now, let's talk about how to approach entering a trade like a true professional. The key idea here is that you want to enter like institutions do, but exit with the professionalism of a seasoned trader. Remember, the potential reward should significantly outweigh the risk, so always aim for that favorable risk-reward ratio, ideally at least 1:3. When you're ready to enter, your entry should be placed at an optimal point, specifically at an order block or a fair value gap. This helps ensure you're trading at a logical level where the market is likely to react. If your entry is refined, it means you've fine-tuned your position to increase your chances of success. A crucial signal to look for is a decisive market structure shift. This indicates a strong change in the market trend and signals a good entry opportunity. Once this shift occurs, you know the market has potentially turned, making your trade more reliable. Additionally, you want confirmation that a sweep of short-term liquidity has happened, what we call an MSS confirmed. This liquidity sweep often precedes significant moves, so seeing it gives you added confidence in your setup. Another important factor is observing a liquidity sweep at the lower timeframe, or LTF liquidity sweep. This shows that price has reacted to a key point of interest on a higher timeframe, which adds weight to your trade idea. Speaking of higher timeframes, respecting the higher timeframe point of interest means that price has reacted to a significant level on the bigger picture. This respect indicates the market is respecting its key levels, supporting your trade direction. And finally, your higher timeframe bias should be aligned with the current market trend. When all these elements, structure shifts, liquidity sweeps, POI respect, and trend alignment, are in place, you're in a strong position. Before you click buy or sell, always go through your sniper entry checklist, making sure every box is checked. This disciplined approach helps ensure you're entering trades with confidence, precision, and professionalism.